fundsupermart.com.
So I'll start with your outlook. Where do you see Singapore bonds going for 2013?
I think Singapore bonds is expected to do well in the next 12 months. Why is this the case? Basically, it's driven by the fact that there's higher liquidity within the system. So basically, we expect a lot of funds to chase after the assets. Okay, not that it's really a bubble like some people say, but generally speaking, people are just trying to put money to work. On top of that, Singapore is one of the few countries that has AAA status. So what happens is that from people looking to place assets in a safe haven, Singapore will be one of them. Right. And on top of that, I think generally there's a shift in mindset in terms of just having only equities in the asset location. Because what happens generally Singapore, like the rest of Asian markets, is equities driven, but they're probably looking on the perspective that maybe they want allocation of fixed income for the fact that it offers a carry component to their investments.
So share with us, what are some of the positive drivers you see benefiting Singapore bonds?
Okay, as mentioned earlier, Singapore being one of the few AAA countries has attracted inflows from not just governments but as well as high net worth individuals. Plus the fact that the currency is expected to be strong near term, so a lot of people will be looking to park their assets. But of course, the offset here is that if you place it in cash deposits and stuff like that, it's rather low yielding, probably about 20 basis points. So corporate bonds have been yielding pretty decent. Say about 5-year bond is probably yielding somewhere between mid 2s to 3%. So that actually represents a good yield pickup for investors who wish to be here in the medium term.
Okay. What about the flip side? What are some of the risks that investors need to be aware of before they jump into Singapore bonds?
Well, one thing is really credit risk in terms of, no doubt it's a safe haven, but you're still investing in corporate bonds. So you face the corporate credit risk, i.e. default risk of the companies. But generally speaking, I think what you have in Eastspring Singapore Select Bond Fund is that we have a rigorous discipline for evaluating bonds, and generally we would tend to invest in the investment grade bonds of foreign overseas issued, basically debt issued by the foreign entities. And on top of that, for Sing, basically we have easily recognizable names such as Fraser and Neave, City Development and CapitaLand. And even the likes of the local banks like DBS and UOB. So names which investors would be able to easily identify with, right?
Okay. You did mention just now that cash deposit yields are really, really low. So, how useful is this for, say, a really conservative guy who wants a little bit more yield on his cash? How useful is a Singapore bond exposure to enhancing yield?
Okay, just as an illustration, right now we're seeing deposit rates between 20 to maybe 50 basis points just on average, and on off you have the promotions by the banks to entice new funds, which can be between 50 basis to 1%, but that is probably temporary. If you look at where Singapore corporate bonds is yielding right now, it's generally yielding about 3 to 4%. So that represents a good, net of expenses, probably at least 2 to 3% of pickup. For an investor who is looking for medium returns, I think that is a good vehicle to look at. Because if you think about it, it's no doubt people will talk about interest rate going up, all those things. But you definitely, if you take a buy and hold type of strategy, in the medium term, the returns of it will normalize towards 3 to 4% on average basis. But of course, if you look to buy today and flip, say maybe half a year to a year down the road, the returns will not be that certain.
Well, I was looking through your October fact sheets, and it says your fund has sort of performed 6.8% versus the benchmark is about 5.2%. So this is really a good margin of outperformance. What is behind this outperformance, and do you expect it to carry on in the future?
Right. I think what happens is that the outperformance this year has been largely to our overweight in corporate credits. Just a background, the Eastspring Select Bond Fund was created primarily to capitalize on the growing Singapore corporate bond market. So as a result, we managed to take advantage of this and got a huge overweight in the corporate bond sector. And plus the fact that we were also long duration earlier part of this year, where people were expecting interest rates to go up, but it went on. So that has benefited us. Going forward, I think at the moment, to share the strategy is that we are currently neutral duration to the benchmark and have reduced our bets on the corporate bonds in the sense that the easy money for corporate bonds for the earlier part of this year is gone. But again, this is not being inconsistent, but rather we think that we need to be more prudent in terms of our security selection of the corporate bonds. But we think that the right bonds still offer a pretty decent carry of about 2 to 3% over similar fixed income, like for example time deposits and government securities.
Okay, Danny, thank you for your answers.